And so as long as we are super good looking and we do the right advertising, we will get their calls. And when we get their calls, it's up to us to do a quality sales process and fill these beautiful properties.
I love that model. Josh, let's talk a little bit more of why it's critical with seller financing these days. I think we briefly shed light on it. So one ironic part is if you looked at any of the headlines and why commercial real estate is in trouble, usually those headlines are very national or office building in San Francisco went foreclosure, so everybody's in trouble type of thing. But the truth is, the industry today, the deals that are in trouble are the ones that were bought with bridge loan or variable interest rate financing. Your situation is completely different. Since I've known you in 2018, banks never really liked the hospitality space. So I think it's forced you guys to adapt back then, which now has led you to not have the same issues. Like I've never seen you do a bridge loan or variable debt type of thing. Most of the time it's seller financing. Now I feel like you guys are in a much stronger position than a lot of the traditional multifamily deals. Can you shed some light on how that kind of evolved and where you guys are and where you see the, I guess, the appetite for bank financing to be in 5 to 10 years?
Okay, so this is a happy accident that when we were getting into this, there was actually pretty viable traditional bank debt available to a stabilized resort business. And I had just done with my previous partnerships, we had just done a big, gigantic refinance, and banks loved us. Two things were different when we got to Renault. It was an underperforming, not very much performing at all, and had bankruptcy on its record because at the time I bought it from a bank. So those elements, plus the fact that we had physical rehab to do and business operational turnaround, made it impossible to get traditional banking. And that'll be like that in any market, I think, Dennis. So that one we knew eyes wide open, this isn't going to work for a while. Maybe we thought 3 years, and then 3 years came due right during the COVID. So clearly the 3 year goal of trying to get a normal bank didn't work. And then, but the hold period was always supposed to be infinite or indefinite, I should say, long term. So what that taught us is we used traditional construction structures, which are more expensive and are based on capital improvements. So that's the model we used at Renault, which means our double digit interest rate was part of our pro forma. And honestly, in hindsight, that's why we've kind of had success through these difficult financing times now, because it's always been tough for us. It's almost like you work on your muscles and they get stronger. So, yes, we are grateful that we've always had a high interest rate environment in our type of hospitality. And when the economy when we mature as a company, and when the economy matures, we're going to be able to get really favorable refinance structures, and that's going to be a nice surprise, nice positive for the investors. And you know what else is going to help us be very attractive to banks as the economy stabilizes at whatever interest rates 26 are going to be, whatever, is portfolio building. So banks do appreciate a portfolio. Maybe we'll get offers to do a really attractive package for all of them, or we'll have just the brand promise spread across a portfolio. Will actually improve our cap rate when being analyzed by appraisers and or investors. They will benefit us with a lower cap rate. But those are some interesting things. I don't know how deep you want to go into all that.
No, I think that's the interesting part about it is how different it is from multifamily, where you guys started at a disadvantage.